A lot of traders don't understand what spread is. So in this video, I'm going to be explaining what is spread, what is bid and ask price, and what pip and pipette is in forex trading. Hello, what's up guys? It's Clarkson Trades here, the hybrid trader. If you're new to my channel, I would like you to subscribe now and hit the notification bell so once I drop a new content like this, you are going to be notified. So let us start with spread. Spread is simply the difference between the bid and the ask price. Bid price is the price at which the trader is willing to sell a currency pair, while the ask price is the price at which a trader is willing to buy a currency pair. Let's take for example, you go to the market and you want to buy a plantain. The seller of that plantain says that that plantain is 1,500 francs. That 1,500 francs is the price at which the seller is asking you, the buyer, to buy that plantain at. But the price at which you end up buying that plantain, let's say is 1,300 francs, is the bid price, and which is a price that the seller sold that plantain at. So that's just a simple example in a practical world of what bid and ask price is. Same as forex. Bid price is simply the price at which you are willing to buy to sell a currency, while ask price is the price at which you are willing to buy a currency pair at. So basically, spread is simply ask price minus bid price. The wider the spread, the more the trading cost, and the lower the spread, the less the trading cost. Meaning that spread is simply that money that you as a trader, you pay a broker. This is how you pay a broker. You can either pay a broker using by spread or by commission. So most of the times when traders intend to choose a broker to trade with, they look at things like spread. When they want to look at their strategies, spread also matters a lot in their trading strategies. Choosing a broker and also evaluating the cost of trading a particular currency with a particular broker, because spread varies across different brokers. That's why it's easy for you to hear a trader says that this broker is good, they have low spread. It means that the broker has low cost of trading currency pairs, including assets like you have commodities like gold and other indices like S&P 500, Nasdaq, US 30. So a proper understanding of spread also helps us as traders to know which session is good to trade forex and when to stay out of the market. You see, most traders trade during the London and the New York session because on those sessions spread are very tight and there's high volatility. Meanwhile, on sessions like the Sydney session, which is around 10 p.m. GMT plus one, spread is very wide. Sydney session and beginning of Tokyo session, spread is very wide, especially in the Sydney session, which is not a good time for you to trade forex because you can get stopped out when the candlestick has not yet reached your stop loss price. So understanding when to trade forex also helps you to make money in the forex market, and having a proper understanding of spread helps you to know when to trade and when not to trade. For example, on days like bank holidays, you realize that the market is very choppy and spread are always wide during bank holidays. For simple understanding for beginners, spread is simply that space in between the ask and the bid price. If you go on your MetaTrader 4, go on chart, you are going to see two lines there. The one up is called the ask price, while the one down is called the bid price. That gap in between is called the spread. It's called a spread. So you realize that across session spread can increase, and across different brokers spread can also increase. So choosing a broker that has a low spread is very important as a forex trader. That is why I'm going to recommend the best broker for you to use on the description box. So check on my description box. You are going to see the broker that I trade with. They have relatively low and tight spread. So now let us talk about pip. Pip is simply the smallest price increment in the market, or is simply one unit measurement of price increment, or you can say it's a step movement in the forex market. Now for beginners, we all know that the market moves, the market is never stagnant. So one movement of the market is called a pip. Like if you move a step, if you're walking and you move a step, you can see you have moved it one step. If the market moves one step, is called a pip, for simple understanding. So a pip is simply movement in the forex market, and one pip is simply one unit increment in the forex market. Pip is the fourth figure after the decimal point for pairs like Euro USD, GBP USD, New Zealand dollar USD. Pip is the fourth figure after the decimal point. But for JPY pairs, pip is the second figure after the decimal point for pairs like GBP JPY, USD JPY, CAD. All those pairs has the Japanese yen currency quoted to it. Pip is the second figure after the decimal point. So I'm going to show you how to calculate a pip, because having a proper understanding of how to calculate pip helps you to know how to set your profit target, your stop loss target, and to know how many pip the market has moved at a particular time. So it's going to help you to make informed decision on your trading.